if you are wanting to buy in some of these markets, I think there's going to be great opportunities. Not here yet. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello, welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer, and just doing a solo episode today. So on these Wednesdays, Matt Jones and I usually get together, but Matt, he's busy. So we're not getting together today. So I'm just going to talk a little bit about what's going on, what we've been seeing. We had this, so we did an investor update where we talked about where Endurance Capital's been, what we did in 2022, what we're seeing in 2023, kind of our expectations. Of course, kind of a crazy time that's going on in the market. Really interesting. There's a lot of things you can really draw, a lot of conclusions you can draw as you look at things. I can literally listen to one person and it sounds like the smartest person in the world. I'm like, wow, that's amazing. That's exactly what's going to happen. They'll tell me that the market's going to crash and that prices are going to go down 25, 30%, blah, 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 whatever it might be. And I'm like, man, they sound so smart. That's exactly what's going to happen. And then I listen to the next person and they're like, yeah, prices are going to go up by 2-3%, probably not going to see quite as much growth, but here's why. And they give me the fundamentals. I'm like, man, that person's so smart. That's exactly what's going to happen. So we've tried to really come up with our own conclusions ourselves, knowing that, really likely we're definitely going to be wrong, but at least we've thought about some of the things. And we're also looking at all our properties currently, what we've got currently in our portfolio and going, okay, well, what if this person, many people that are saying that the market's going to crash, what if they're right? And what do we need to do to our portfolio to protect it? And really we buy on the front end to make sure that that we are protecting ourselves in kind of some downfalls, some bad scenarios, but we want to continue to make sure we're always looking at that and go, okay, how can we improve? How can we continue to run our properties effectively? How can we grow the business and be successful? So that's kind of how we're looking at things this year. What happens if these doomsday experts are correct? How do we fare? How does our portfolio fare? And what can we do to improve it? What can we do to make sure that we're still here, we're still around, in 2024, 2025 and beyond? And then we also look at kind of some of these best case scenarios because we're also buyers and we want to continue to grow our company. So what does the market look like both in the bad and the good? And how does that affect us? And where can we go with those things? So with that said, I'm just going to kind of run down. We've talked about a lot of things. We had a lunch, by the way, if you're in the Twin Cities, if you're in Minneapolis, St. Paul area, we're having these quarterly lunches. It's kind of replacing the North Star Real Estate Conference. So join us on the next one. And that's going to be, I think it's the end of April, beginning of May, that we're going to have the next one. I'll make some announcements with those dates, but follow us and you'll see some information on that. But in that next one, we're going to be just talking about how, raising capital, what we're doing to raise capital. Hoping to have a great guest into private equity guest and kind of what we're doing to bring capital into the deal. So here's what's going on. Here's what we're seeing in the market. So first of all, everybody knows interest rates have gone up. In multifamily, we got Fannie, Freddie. Those are the agencies, life insurance companies, HUD. So, and then you got bridge loans. So bridge debt has really kind of disappeared. Oh, and local bank too. Bridge debt's pretty much disappeared. We're just not seeing a lot of bridge loans. If you're trying to get a 10 million plus bridge loan, you definitely have some options, but not nearly as much as you did even 6-12 months ago. That's all you saw was bridge debt. And so that's kind of gone to the wayside. We have agency debt now, Fannie, Freddie, you're putting quite a bit more money down. Typically you're putting like, 30+% down, 30 to 40% down payment. And so you got to come up with quite a bit more money. You're going to have to do the renovations out of your pocket. And then you do have the local banks, but the local banks there was a small period of time where the local banks were actually the cheapest money. where the agency debts have raised their rates, to 6%, 5.5%, 6%. And the local banks were sitting there at like 4% still. They had some cheap money, but that money is gone from these local banks. So you're seeing the money a lot more expensive, and you're seeing, full recourse, or at least, partial recourse. Also seeing that they're 25-year amortization, 25-year amortization fixed for only, 5 years or so. And then you're seeing interest rates in the 6s and maybe 7%. So it's not nearly as lucrative. So right now in multifamily, the most lucrative loan is going to be your agency debt. You can get those you can get those amortized 30 or even 35 years. And then the loans interest rates are going to be the cheapest. So we just got a debt quote at 5.7%. You're seeing anywhere between 5.5 to 6, maybe 6.5 at the highest. Interest rates have gone up. We were actually seeing them closer to 5 at the cheapest. And so now they've gone up a little bit. I'm recording this in early part of February. Fed just raised 25 basis points. So there's still volatility with the interest rates. Single family homes, of course, are even higher. So volatility with the interest rates, we'll see where it goes. But the Fed keeps on posturing and saying that, hey, we're raising rates until we get to that 2%, or until we feel like we're at 2% inflation. And so I expect that to continue. I expect rates to stay elevated for quite a period of time. And it's going to disrupt the market. The more volatile interest rates are, the more volatile the economy is, and potentially just with what's happening, it just creates uncertainty in the market. And so you're going to have buyers and sellers who just aren't quite sure what's going on. As the market stabilize, as interest rates stabilize and all that kind of stuff, we'll have this pricing kind of discovery we're having this pricing discovery, and we'll kind of have this realization of this is where pricing needs to be. Sellers will say, yep, we're willing to sell at this price. Buyers will say, okay, we're willing to buy at this price. And so we'll have this kind of realization and stabilization in the market. Doesn't mean that prices are going to go up. Doesn't mean that prices are going to go down, but that, I think, we'll have this kind of really just realization of here's where pricing is. I do believe that some markets are going to see some major down, and I think others are going to see some stagnation, while others might see some upward. And it's like anything, when we're talking real estate, it's very local. We can have nationwide statistics, and I'm going to say nationwide statistics, but that's just not how real estate really works. So, we can all spout out statistics and say that that's how it is across the nation, but that's just not how it works. Things that we're really looking for, right now is long-term debt. We want long-term fixed rate debt, just good, solid debt. And we want to see good, solid debt in great locations. We sold our C-class assets, really wanted to see better, well-located properties. And so we're really fixed on location, on where we're at. We want very solid location. When you look at kind of the history and what goes on in real estate cycles, and again, whether we're in the cycle or not, or in a transitioning cycle or not, well, to be determined, right? We don't know until hindsight, but assuming we are, every cycle, the history that we can look back at history, C-class, it goes down the most percentage wise, it stays down the longest, and it takes the longest to go up, and it goes up the slowest. And so when we look at it, maybe A-class monetarily goes down more because rents are way more. But as far as a percentage goes, C-class gets hurt the worst. It just does. And I know some people don't believe it, and they say, A moves down to B, and B moves down to C, and C just doesn't have anywhere to go. Okay, that sounds great. It sounds great on the surface. It's just not true. And then the other false thing, or the thing that makes it not true as well, is that C-class can't pay. So even if they do have high occupancy, they just can't afford to pay, because whose jobs get cut during a recession? Well, it's typically the C-class. It's those people that are working, at restaurants and at factories and things like that tend to get cut, and they're living in C-class properties. So unfortunately, that's who gets hurt the most, especially, we're talking inflation, high inflation environment. who gets hurt the most in a high inflation environment is going to be the C-class type residents. So anyways, we have migrated to B class over the last several years. It's been really since just prior to the pandemic. We've migrated to B class, A class assets. So that's a big thing kind of we've been looking for. Some interesting things happening here in the market. Again, this is nationwide, but we've seen that rents are declining. Rents declining nationwide. And it's funny because there's all these headlines saying rents are declining, so it sounds really bad, but we are in the winter, right? And we typically see rents decline in the fall. And so that's exactly what we saw. So we saw September of 2022, the first month with negative rents. Well, if we look back at history, that tells us that's pretty accurate. September, October, usually you're seeing some negative rents. And so we see these negative rents, September, October, November, December, and then January usually starts to pick up and turn into a positive, a very slow positive. But that's kind of how history has gone. Now, if we look at more of a localized aspect, you can look at markets that blew up during the pandemic. A lot of markets went up by 20, 30%. And we look at those markets and see that we're seeing the exact opposite happening. So let's point out a couple markets. And these, by the way, these are markets, if you're listening to this, these are markets to really keep an eye out. I wouldn't touch them right now. I wouldn't even think about buying or investing in these markets. But I think there's going to be opportunities in these markets, because I think what you're going to see is owners, especially owners that bought between, really the start of the pandemic to today, they're going to be, now I'm not saying everybody, of course, everybody's a big statement, but a lot of them are going to be needing to recapitalize. They're going to need to sell. They're going to struggle. And so if you are wanting to buy in some of these markets, I think there's going to be great opportunities. Not here yet, but think of markets like Phoenix, Arizona. That's probably in my opinion, likely to be ground zero of pain, real pain. So Phoenix, Arizona, Austin, Texas, Atlanta, Georgia, Las Vegas, Nevada, Tampa, so Orlando. So those types of markets, Charlotte, Raleigh, saw these big, huge increases and are likely going to fall flat on their face. And they're already doing that. Phoenix, Arizona had negative 2% rent growth in 2022. Las Vegas had like negative 3% rent growth in 2022. Atlanta had, I think, right around a 0%. It was slightly negative 0.3% or something like that. And so we're already starting to see that. And I think we're going to continue to see that. I can see some of those markets going down by 10% or greater. And the crazy thing is, a lot of these syndicators, there's a couple of groups that I can think of that are literally analyzing stuff going up by 7 to 8% a year. Of course, they fool their investors by showing like 3%, but they're really, if you dig into their numbers, are going like 7 to 8% rent growth, which is crazy considering they're actually dropping in rents by 2% and probably a lot more.
Hey, real quick, this is Matt Jones. Thanks to Todd for doing the solo episode. But today, February 15th, we're going to be hosting a real estate networking happy hour at Bent Brewstillery at 5:30 p.m. So you can join us. I'm going to include the information in the podcast notes. But again, that's today, February 15th, 2023 at 5:30 p.m. on. We hope to see you there.
The other thing to look out for is deliveries. What is coming onto the market? So I'll pick on Phoenix again, because again, I think that's ground zero. Phoenix is building 38,000 more units, and the absorption rate last year was 11,000 units, and it's expected to actually be less than that this year. So they're building 38,000 and they're having 11,000 people move in. That's a problem. And so you're going to see a higher amount of vacancies, which is going to push rents down even further, going to drive up concessions. So those are definitely issues. And Phoenix is not the only market. There's many. In fact, even some slow growth markets Minneapolis, my hometown market, they're increasing the rental supply by 10,000 units. That's never been done before. The problem with Minneapolis doing that is there's no growth. There's literally almost zero growth. And so we've got this market that's adding all these units and taking very few offline, and we've got a problem there. So things to really watch out for is what supply is coming on the market. I think that's going to be really interesting this year. There's expected to be a record amount of units across the country going online, and as we hit a recession, people start to double up. Those units are going to be tough to fill, and those units will get full. But what's going to happen is the other properties around them are going to suffer. So I'm looking for markets. And again, I like slow, steady. I like Midwest. Even with Midwest, though, like I mentioned with Minneapolis, you got to be careful because it's every market's super local, and it doesn't mean that just because it's Midwest, it's safe and insulated. You got to look at what's happening in the fundamentals. The other thing to really look out for is expenses. We are projecting our expenses to go up considerably. Income's up 13%, insurance is up 9%, property taxes are up 12%. This is nationwide statistics, so again, take it with a grain of salt. But expenses are up. Utility costs are up, I think 8%. So expenses are up 21% for turnover. That's the growth in turnover expense. So again, nationwide, but you got to pay attention. In some of these markets that have had this skyrocketing rent have also had skyrocketing employment costs, so people are making more money in those markets. And so instead of income growth by 13%, they're seeing income growth by 20%. And so all of a sudden you're seeing rent go down by 2%, expenses go up by, maybe a blended of 6, 7, 8%. And you can see how quickly you can be upside down. So you just be aware again of what's going on, but it does open opportunities if you're not in those markets. Of course, if you're listening, you're in those markets, you've been buying for the last couple of years, really, you got to figure out how to fundamentally operate your properties. Hopefully you've got great cash reserves, and maybe have to do some capital calls, but hopefully you can last through this, kind of tough time period. But I would be ready if you're sitting in those markets, you already have properties. So some of the other things, we've been looking at, thinking about is really kind of supply. It feels, the numbers tell you that we have this big need for housing. But one of the things we want to be careful of, and I don't think enough thought is put into this, is there's need for housing, but housing need is not equal across all boards. Demand is not equal. Demand is different. In a really good growth period, demand is extremely high. As a recession happens and as people are kind of pulling back, as expenses get too high, as inflation gets out of control, well, what happens is people then tighten down and they start staying, they stay with mom and dad, they start rooming up with friends and family and things like that. So people figure out how to survive. And I think that housing, although there is housing demand out there, again, it's not equal. And it can be moved pretty quickly. The other thing that's not equal is when we look at, everybody just talks about, oh, we need more housing. So automatically it means we need more multifamily housing. But are we sure? If we look at the demographics, look at what's happening, these millennials are getting older and they're going to want to move into houses. And so is it the demand in multifamily or is the demand in single family? There's a little bit of both. And I think it's a little bit of both. And so again, as I'm looking at markets, I'm really looking for markets that don't have this crazy building, crazy supply going on. I want very little supply coming into my market. I want to make sure my absorption rate is, staying pretty steady. We want units absorbed. We don't want units sitting around. So 2023, again, we're focused on in-place operations. We're not looking at blue sky. We're not looking at where can we go? Certainly we have an optimistic view. I still love multifamily. Look, I know I've been dogging maybe multifamily a little bit and real estate a little bit, but I still love multifamily. I think it's very strong in the future. And even these markets that I've mentioned, Phoenix and Raleigh and Atlanta and so on, those are, Austin, Texas, those are high growth markets. They're probably going to see some pain now. Like I said, if you bought in the last couple of years, boy, look out. But there's going to be opportunities in those markets. And I wouldn't hesitate to buy in those markets as, things really settle down and likely values go down. It's funny. We're already seeing, I was talking to somebody who was in the Phoenix market and they think it's still too expensive, but they had a property that was being shopped to them for over 300,000 a unit. And they had it come back to them at just under 250,000 a unit. That's a big drop. And they said it's still too expensive. They need to be around 200,000 a unit, but that's their drop. And that number is roughly 20%. They think it needs to go down another roughly 20%. But that's a 40% decrease. That's pretty, those are pretty big numbers. So, but again, I still think multifamily is strong. It's going to be market dependent. It's going to be really trying to understand some of these fundamentals. Housing is expensive, and that's one thing that's going to probably help the rental market. Is that if you look back into 2020. So if we look at 2020, for instance, and we could say the median home sales price is right around $275,000. Okay, $275,000. That's what you could buy a house for. So let's say you're going to get an FHA loan, which is your traditional first-time home buyer. Their payment at that time is $1,147. $1,147. Okay. Now let's just fast forward that then to the end of last year, even right now, the average home sale price is about $385,000. So it's gone up considerably. It's gone up by over $100,000. But the payment is what's huge. The payment is now at $2,400. That is a big difference, going from $1,150 to $2,400. That's a massive difference in affordability. And so that definitely helps out rental houses because people can't afford to live in these properties anymore. They're going to have to pay less for a house, or they're going to just have to save more before they can actually get into that house. So that's definitely something that's good for the rental market. I don't think it alleviates all the potential issues of the rental market, but it definitely helps cure some problems when you have housing affordability and people have to stay in their rental houses for longer. Of course, today we had information that jobs are continuing to grow. It just continues to go up. There's so much demand. People need workers. And I don't see that stopping. Baby boomers are retiring and there's need for employment. I don't know how that's going to change at all anytime soon. And that's probably our biggest risk for inflation continuing to go, is that we just don't have the labor force, and it's only retiring. It's just going to continue to retire. Okay, so back to opportunities. Look, I think what you're going to see, and it's going to be probably across the board, but I think again, in some of these markets, these kind of more ground zero markets, what you're probably going to see is a lot of people put short-term debt on these properties. They didn't leverage them well enough. They didn't have enough cash reserves. Sorry, they leveraged them too much. They didn't have enough cash reserves. And so they're coming to a situation where they need a capital infusion. And certainly people are going to be able to do a capital call. That's great. But, that's not going to be for everyone. And so I think what's going to happen, there's going to be a couple things that are going to happen. So some properties are certainly going to get distressed and going to have to sell, and they're going to sell for a discount. So there will be some opportunities. I think those will get swallowed up pretty quickly. You have to have good relationships with brokers. Those properties are going to go quick. The other properties are going to be more silent transactions. There's a ton of money sitting out there. Last I heard, there's over $1 trillion of money sitting out there, and they've raised money from investors. private equity groups, some smaller syndication type groups. And what they're looking for is they're looking for opportunities to come in and recapitalize deals. They're going to come in, they're going to buy into the property and basically the rescue money. It's rescue money. It's saying, hey, we know you're struggling and, you need $5 million, $3 million, whatever, to recapitalize your property. And we'll do that for you. But then in turn, what they're going to do is they're going to take over ownership. Investors are probably going to lose a decent amount of money on that, or maybe all their money. The GP is going to lose a decent amount of money, but what it'll stop is it'll stop that foreclosure. They'll stop that big, nasty red mark, kind of on their record. And again, maybe allow them to get out and their investors can capitalize on 50% of their money, on 30% of their money, whatever it might be. But then new money comes in and it refreshes the property and they can get a new long-term fixed rate debt and continue and hopefully then survive and thrive. So I think there's a lot of that money that's going to help out. And, it's good and it's bad. Of course, it's bad for those people that are stuck. It's good for those people that are stuck though too, and help them out of a sticky situation. I think rents are going to just continue to soften. Again, not all markets are the same. I feel like a lot of the Midwest markets that have had slow, steady growth are going to continue slow, steady growth, just not quite as fast as before. Instead of 6 to 8%, you're going to see 2 to 3%, maybe 4%. Those markets that saw 20, 30% growth for a long period of time, those are going to see negative growth and they're going to get back to where they should be. So I think that's going to be happening. I expect that, there's construction happening right now and people are exuberant, but everybody sees things and then goes crazy and then they go crap. And so I think people are going, oh crap right now. So I expect housing starts to slow down, and I shouldn't say expect that. That's already been happening. And I expect that to continue to happen for the next, I don't know, a year, maybe. We'll see. We'll see how long it goes. Kind of depends on interest rates and the volatility of the economy. So I do expect that to continue to happen in multifamily, which I think is a good thing. I think that's a really good thing, especially for multifamily. Single family, I think there's still a lot of need for houses, but multifamily, I think it's a good thing to put pause on some of these markets. So hopefully that'll catch up and allow some of these markets to breathe again. So anyways, that's kind of my rundown of what's going on. Probably pretty long-winded, but a lot of thoughts that I have. I have a lot more thoughts, of course, of what's happening in these markets. But I think 2023 is going to be a really interesting year. It's going to have potential for some opportunities. And 2024 is going to have definitely even more potential for some opportunities. There's a lot of loan maturities coming. There's just a lot of things coming on the market where I think there might be opportunity. I'm overall still very optimistic, but overall, I do think there's going to be isolated pain points throughout the market and opportunities for those who are willing to take that risk and who are really on top of things. I think that it's not going to be this big, massive 2008 type crisis again. I think it's going to be those who are opportunistic and those who are really looking and digging in. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedexheimer.com venturedproperties.com, venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.